Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Prashant. With me, my colleagues Nigel and Reema. Guys, hi, good morning.
Hi, good morning. Tensions in Middle East escalating back home. The aviation sector and India is mourning. The death toll is rising. It's Friday the 13th.
Well, that's right. Very, very depressing news coming in the last 24 hours or so with regard to the plane crash. You have, Iran as well as Israel that are engaging out there. So, I mean, it's a Friday the 13th, and you don't want to wake up to these sort of cues, but that's what we are faced with today.
Absolutely. And those are visuals which are coming through. And with the volume up, you can hear the sirens going off, etc. So this is basically early morning. If you're just waking up to it, this is early morning today. Israel essentially striking Tehran, and now, of course, also kind of sort of indicating that they're striking some of the. These are reports, not confirmed, but taking out Iran's nuclear capabilities. So some of this is, of course, still ongoing, basically. More visuals, etc., coming through as we go along. All right, let me just quickly then take it from the top in terms of what you need to know as we begin this session. And there's only one thing, actually. So if you looked at markets and how U.S. markets left off at, say, 4 in the morning, they were nothing. I mean, S&P was up about 1/3%. Yields were well behaved. Dollar was down, etc., etc. All of that changed as news started to come in at around 5 our time this morning that Israel has struck Iran. So oil's jumped 7% as these strikes have happened. And I think between 6 to 8%, I mean, up and down. But basically, it's a very large jump that you have as far as oil prices go. There you go. That's the big move that we're talking about. 9% now on oil. So explosions rang out, as you heard for yourself, across Tehran, Iran, across various parts of the country. It's now, of course, been confirmed. There's a video of IDF, Israeli Defense Forces commander, essentially saying why they've done it and why, so it's official. It's no longer reports, etc., which it was about 2 hours back. Israeli military official has said that his country has targeted Iranian nuclear sites. Israeli forces say military operation against Iran is expected to last several days. So this is not, one and done, and it's not like. You sort of go in, surgically strike what you want and then come out. This seems to be well planned, and, Israel seems to be prepared to take out Iran's nuclear capabilities, nuclear facilities, etc. That seems to be the contention out there. President Trump is, and of course, Israel has declared a state of emergency to kind of anticipating strikes, some counter strikes from Iran. President Trump in the U.S. is convening a cabinet-level meeting. This is what CNN is reporting. And it's quite, strange. President Trump tweeted just earlier, a few hours back, that before these strikes started, and there was yesterday same time we were saying that, maybe the U.S. State Department is going to ask U.S. personnel to vacate in the embassy, etc. But President Trump's tweet did not indicate at all there was a big sort of flare-up coming, etc. But Israel, and these are reports, Israel is through media reports, etc., seems to indicate that they informed Washington, informed U.S. that this is essentially going to happen. But in any case, this is something to keep an eye out on. Of course, these attacks now significantly reduce the likelihood of a U.S.-Iran nuclear deal. Implications, of course, primary implications are with regards to oil. So just straight away to oil, the 200-day moving average for oil is, these are basically all the resistances. The 200-day, we are above it now. That's about 72. The next one is 75.47, I think, which is where we are right now. That is the April high, $75.47. And then $76.46 is the next resistance. So, we've seen a very sharp, almost with this 9%, yesterday's 4%, very sharp move. So maybe in the near term, these markets respect these resistances. The big unknown at this point in time, and then all bets are off, is if the Strait of Hormuz, which is through which a significant amount of oil capacity passes and which Iran has the capability to close. It's never been closed, by the way, and we'll talk more about this later. If that were to come through, I mean, then you're looking at, significantly higher oil prices. So we don't know. As things stand right now, these are levels you need to watch out for. S&P E-minis are down, which is US stock futures, index futures. Treasury yields are higher. Gold, this is typical risk-off, which happens. I mean, bonds are bought, gold is higher, and stocks are lower. I'll just put out sort of two on downside levels for both the Nifty and the Nifty Bank. Nifty, of course, ended below the 40 hourly and it ended sharply down, 1% cut. Support here stands at 24,847 and 24,500. So 24,847 is going to get taken out straight away. That's a 20-day moving average. And then the 40-day exponential is 24,500. By the way, it's also the weekly close, and we'll see what happens in that sense. Bank Nifty has been down for 3 straight days. We got a decisive close below the 40-hourly exponential moving average yesterday, and support here stands at 55,711. Again, I mean, it's not very far away, and most likely we get that gets taken out right at the word go. But I think closing will be important to track as well. GIFT Nifty should give you a quick sense of how we are likely to start. It's 200-point, clean 200-point gone. As far as the start is concerned, indicative start on the GIFT Nifty. Rima.
Well, news is also just coming in that the Iranian state media has reported that Hussein Salami, the commander-in-chief of Iran's Revolutionary Guards, was killed in the strikes. This is what CNBC, the global channel, is reporting. So it's all happening right now. Let's quickly revisit the statement that's coming from the White House, statement from Secretary of State Marco Rubio. He said, tonight, Israel took unilateral action against Iran. We're not involved in the strikes against Iran. Our top priority is protecting the American forces in the region. Israel advised us that they believe this action was necessary for its self-defense. President Trump and the administration have taken all the necessary steps to protect our forces and remain in close contact with our regional partners. Let me be clear. Iran should not target U.S. interests or personnel. Let's quickly once again revisit. This is the big story which is breaking, the market reaction that we're seeing. Prashant spoke about the 9.5% spike in crude oil prices. I think this is the biggest intraday spike that we've seen in crude prices in more than 2 months. U.S. futures under severe pressure. The Dow is down more than 600 points, inching towards a 650-point fall. Across the board, key U.S. indices are down 1.5%. And there is a rotation taking place into safe havens. So gold prices are now quickly trying to get towards their all-time record high levels of $3,500 an ounce. I think it's $3,440 on gold right now, 1.5% higher. Swiss franc, Japanese yen has strengthened. The surprising bit is that the dollar index is weakened. So typically in times of risk off or geopolitical uncertainty, there is rotation even into dollar. But today you've seen the dollar index slip to the lowest level that we've seen in the last 3 years, and it's around that 98. Once again, why is oil reacting so sharply? Because Iran holds significant oil production and it controls the strategic choke point of Strait of Hormuz. JP Morgan yesterday said that if Iran closes the Strait of Hormuz, then oil prices, according to them, could spike even to $120 per barrel. Back home to run you through the flows. Yesterday, the DIIs bought about 9,400 crore in the cash market. The FIs net sold 3,800 crore rupees. But all this was influenced by those large deals that we saw. And in Asian Paints, there is that confirmation that Reliance Industries did indeed sell about 3.5 crore shares, and lots more block deals, which we will discuss, will happen today. The promoters are likely to sell in the Jubilant Group stocks, so Foodworks, Pharmova and Ingrevia. And there is the Genus Power block deal too that will take place, likely to take place today.
Well, that's right. It's Friday the 13th, and we are faced with, a lot of headwinds actually for today's trading session. So it'll be interesting to see whether or not we come off the lows of the day towards the end of trade, because the much feared Israel has gone ahead and in fact attacked Iran, which has repercussions for crude oil prices. And that's why you've seen crude oil prices have spiked up. As the last time I saw it, it was up close to 7 to around 8%. And the problem is, the mutual fund industry was sitting on ample liquidity. But on a day-to-day basis, you're having, a few $100 million to $1 billion of selling that's coming in from various entities that are holding stock. And that's what's going to dry up some of this mutual fund, ammunition that they were sitting on. So those are, some of the headwinds that we are faced with. What about the index futures yesterday? Well, you had FIs. They went ahead and, in fact, they added some short positioning in trade, while the clients are positioning as well. should come up for you. So the FIs added close to around 10,000 contracts on the short side. They unwound some longs, while clients, they did the opposite of that. They added close to 6,000 longs and they covered some short positions. What about positioning on index futures? Well, the FIs continue to remain net short with 80% of their positions on the short side. Which brings us to the options data. The 25,100 call, well, that's been fairly active. 25,000 call as well has been fairly active, and the premium's around 140 rupees. The 24,900 put, well, that as well added close to 17 lakh shares, and the premium is around 200 rupees. Which brings us to the levels that we're looking at. On the upside, the recent high, as well as going by the options data, this 25,150 to around 25,200, that's a resistance mark that we're looking at. On the downside, the reference point you're looking at is 24,500, and the range you're looking at based on the options data is 24,500 to around 24,700 odd mark. Stocks that we're going to look at. Before that, let's just keep an eye out on the Nifty Bank as well as the Nifty. The Nifty today will start below the 20 DMA, but you don't want to decisively break that. So you'll want to close closer to the 24,800 odd mark. While the Nifty banks, the first reference point comes in at around 55,700. Stocks we're looking at, because crude oil prices have spiked, it could spell better times for ONGC. They have valuation support as well, and the crude oil prices have moved up. So that's a stock that will react favorably. While we have HBCL as well as Interglobe Aviation, could see a bit of a negative reaction in today's trade. So let's see how it goes. For the time being, gap down start. The hope is at some point of time you get some kind of recovery going.
No, absolutely. And, so we'll see how this one pans out. So the oil marketing companies, all, of course, like yesterday, down 4-5%. And the upstream companies, ONGC and Oil India, again, like yesterday maybe. And this is, of course, a much more significant surge which is coming through. We have Robert Subramanian, he's head of global macro research at Nomura. Rob, great to have you back on the program. Good morning, Prashant here. It's just, I think, as my colleague said, Friday the 13th. I think you can tie it off on that, because it's all pretty volatile news flow. What do you make of it, Rob? And if you've had a chance to interact with your colleagues who track oil markets, etc., is there significant upside if this escalates, if the Strait of Hormuz is closed? It's never been done before. What is your sense?
I mean, I think it's really hard to tell, Prashant, at this point, whether this is going to be a knee-jerk oil price spike, and then things settle down and it's more just between Israel and Iran, or whether this actually broadens out, as you say, Strait of Hormuz, or whether the conflict spreads to other countries in the Middle East, oil producers. The thing for the economies, I guess, and markets is if this oil price continues to rise and it's a sustained rise, then that's when it starts to impact economies, trade deficit, especially Asia, right? India, Thailand, Philippines, Korea, countries like this are large net importers of oil. So you could see exports are already weak because of the US tariffs, and then imports could pick up. So you could see pretty sizable moves in trade balances worsening if oil prices keep rising and stay high. The other thing I'd say, Prashant, we've already got, in the markets, a lot of US policy uncertainty around tariffs, the fiscal concerns, what's going to happen to unemployment, inflation. Markets are only usually good at focusing on one thing at a time, and now they have geopolitical risks rising. So this is a really challenging time for markets. So many different narratives, and trying to kind of pass what it means for ultimately growth and inflation and policy responses.
The CPI print for India came yesterday, and I don't know if you had a chance to look at it, but it was at 2.8%. And now there is hope that perhaps it could even undershoot RBI's inflation forecast of 3.7% for the full year. But now this spike in crude prices, 10% up and counting, can throw all the equations into, can question all the equations that they've put in. Now, considering that we had the jumbo rate cut yesterday, would RBI's policy action of last week look a little premature? And how would you, expect that to play out?
So it's a good question. We were actually forecasting 2.8%, so it's in line with our view. And our forecast for this financial year is 3.3%, so below the RBI's target for inflation or forecast for inflation. So I think the good news for India and to be honest, for much of emerging market economies is inflation is low. In fact, for India, the current account deficit is also quite low. We think it will be less than 1% of GDP this year. And so the starting position is good. Historically, it's been a lot worse than that. So, if oil prices keep rising, India is starting from a relatively strong position, especially historically, to withstand this. So, yes, at the margin, I think for the RBI, it does mean that they would be a bit more cautious on cutting rates here. But we currently expect 2 more rate cuts this year. We still have that as our baseline, but we're watching what happens to oil prices closely. I'd say right now, with what we've seen so far, we're quite comfortable with this view of 2 more rate cuts, just because inflation 2.8% is well below the RBI's target.
Hi, Rob. Good morning. Good to see you, Win. Rob, that we have got softish inflation prints that coming out of the United States in the last 2 sessions. And because of that, if I look at the probability of Fed rate cuts, that's moved up in the last few days. Part of the street believes that in September we get one, and the next cut could possibly come in October as well. But you're not in that camp. Tell us, what are you expecting in terms of Fed action in this year?
Yeah, so I guess the key word we would use is lags. We think that there are significant lagged effects from when the tariffs started going up, particularly in April, and when we'll start to see it showing up on the prices of items on supermarket shelves and then getting into inflation. I think the key point we would make is if you look at the US import data, there was a massive surge in US imports in March, and that was to beat the tariffs. So US companies, bought a lot of product overseas before the tariffs and kept it as high inventories. Imports came down very sharply in April, but we think, there's still an inventory buffer that's running down. And that's why inflation is still relatively low at the moment. But as we get into June, we think in July, August, those months, we think you'll start to see inflation going up. So, our forecast is core PCE is going to be well north of 3% by the fourth quarter. And that's why we really don't have the Fed cutting until December.
Rob, just one last question. That US-China framework deal, we've not heard anything, or have I missed it? Anything from the Chinese side? Because this is all contingent on, and President Trump said in that social media post that this is contingent on, Chinese president and me sort of ratifying this. We've not heard anything from the Chinese side. So, any thoughts?
I think, Prashant, you're right. From the Beijing side, I think they're keeping their cards pretty close to their chest now. I think from China's side, there was a bunch of non-tariff barriers that the US put up since the truce meeting they had in Switzerland, and I think in Geneva. So I think China's waiting to see, some of those to be removed. And then I think the key thing is then they will gradually relax the export restrictions on rare earth minerals. I think that we would still say that there is significant strategic decoupling happening between the US and China. And I think what we've seen in the last 4 to 6 weeks is China's got a fair bit of leverage on the US, more than what the US kind of thought a few months ago. And so, our view is this is, a bit of a relaxation now. Maybe we may see some positive news, maybe not as positive as President Trump is making out. But tensions in terms of trade and investment and this decoupling between US and China, we think will continue.
Robert, just one final question then. What if tensions in Middle East escalate from here on? And of course, it depends on the extent of escalation, the attacks, the retaliation. But just for the sake of scenario planning, if things get worse from here on, help us with your thoughts.
I mean, it's a very tricky question right now. You know, we're really speculating, but I think in the worst case, you know, the thing I think from an economic market perspective, people are focusing on in particular is going to be the oil price. If things really escalate from here. And I think when we talk about escalate, we mean broadening out beyond Iran and Israel. Strait of Hormuz or other Middle East countries getting involved. And if that really starts to lead to a disruption in oil supply, you know, that can be pretty devastating for the world, which, you know, right now, especially for the net oil importers, which to a large extent is, you know, the countries that are most vulnerable are the emerging markets and frontier economies. That would face, already facing weak exports, growth would come under pressure. So we've got to monitor it carefully. And, you know, I think we're all praying that things settle down from here. But it's just one more significant risk. You know, in a usual year, this would be a big one. But we've just had so many big events and uncertainties right now. And markets so far have been taking a lot of it in their stride. And this will be interesting if this does escalate further, whether it really does lead markets to crack.
Robert, thank you very much for joining in. The hope is that the attacks that we've seen so far are calibrated and the situation de-escalates for now. But you can see the risk of crude prices up 10%, and Asia across the board is selling off. Kospi is down over 1%, Nikkei is down 1 1/3. You've got cuts in Hang Seng, Shanghai, across the board. It's deep in the red.
There's Taiwan. The Taiwanese currency is basically shot up some 3%. 3.5% or so. So we'll just have to maybe, we'll look at, we don't think we'll pull up the rates a little later. But that's the other one. It's not showing up in the stock market, but something we've highlighted earlier as well. Let me just quickly run you through the interactions which are coming up over the next 2.5 odd hours or so. So we'll have a discussion on oil with Richard Redogila. He's with Matrix Global, so that's coming up at about 8:30. 9 o'clock, you'll hear from Dayanand Mittal of JM Financial Institutional Securities, and we talk about oil and gas, upstream, downstream, both. Manishi Chaudhary comes up at 9:20 on markets. 9:30, we'll have a discussion with ICRA and Martin Consulting to talk about, of course, the tragic incident yesterday and what it means perhaps for the industry as such, if anything. The management of City Union Bank will be speaking with us at 9:40. Boards approved a fundraise, 9:50. We'll talk about the MDR charges on UPI issue. Of course, the government saying, well, they're not going to reintroduce it. So Abhizar Devanji and Pranav Gundlapalli will be with us to explain to us the road ahead there and what it means for these businesses. Some of them, of course, listed here as well. And of course, it's the economy. Lata's conversation with Hitendra Dave of HSBC India on tariffs, geopolitics, and the India growth story.
Time to slip into a short break, but we've got a lot of stock-specific action to track for you. Get to that in just a bit in our special Top 10 segment. We're looking at Crumpton, DCM Shriram, Torrent Power, and NBCC. They'll be reacting to positive news flow. On the flip side, we'll have the Jubilant Group stocks that will be reacting to negative news flow. That's Farmova, Ingrevia. And then we have supply coming in from Genus Pump, as well as watch out for universal cables and crude sensitives as well will be in focus. Slip into that break, come back. We'll get into further detail on all of these names.
Welcome back. Crude prices are higher, equity prices are lower across the board, and the gift nifty should come up for you on your screen. But let's talk about individual stocks that you should keep on your radar this Friday morning. Our research team is standing by with CNBC-TV18's list of top stocks for the day. First up, it's the blockman, Nimish. What more today?
Well, Rima, a lot of blocks coming in. So 4 blocks today, 3 part of the Jubilant Group and Genius Power as well. And all were part of my deal sheet charter. As far as the Jubilant Group stocks are concerned, Jubilant Foodworks, 1.3 crore shares, nearly 2% equity at a floor price of 641, which indicates a 4% discount. But I understand Jubilant Foodworks might happen in the block window, so that's need to track there. The other 2 stocks, Jubilant Pharmova and Jubilant Ingrevia, large block, 7% stake, 7.5% stake in Jubilant Ingrevia at a 10% discount, and nearly 3.5% stake in Jubilant Pharmova, again 5-6% discount. So all the stocks might open in the red, especially the 2 smaller stocks, but Jubilant Foodworks is something to track because it might happen in the block window. The second is Genius Power, again a large block in Genius Power as well. GIC is looking to sell 5.8%, including the green shoe. The deal size is close to 650 crores, and the floor price indicate 6.5% discount to yesterday's closing price. And GIC owns 15%, so there could be further supply overhang. But to start with, it will be red on Genius Power as well. For the Jubilant Group companies, the combined fundraise would be close to 2150 crores, which the promoters are going to raise across all the 3 Jubilant stock companies.
Nimesh, on this GIC Genius, if you've sort of checked on the background, etc., this was they just came in, right, a few years ago.
Last year, Prashant. So last year they bought 15%.
So they set up this company. GIC was supposed to put in the money, and then they were supposed to. So just a year. So
last year they bought 15% in Genius Power, the listed entity, and they also put in a lot of money for the
SPV.
In the SPV, correct. So that's for the what do you call the meters, smart meter business.
Correct.
So that's what the big commitment came in from GIC, and now they're selling 5.5% stake.
Okay, so objective achieved or something changed? I mean, that's we don't know.
We don't know, yeah, Prashant. We'll have to ask GIC for that. But I guess it's an opportunistic market, right? Every promoter wants to encash and raise money. So,
yeah, no, absolutely.
Yes,
Nimesh, thanks very much for that, and we'll check with maybe try and get the rationale behind it, because pretty quick in terms of getting in and then now sort of getting out as well for a player like GIC especially. More stocks with news flow, and Upasana is here with details. So Upasana, take it away.
Good morning. First up, let me start with Crompton. Company has received LOA worth 101 crore from Maharashtra Energy Department Agency. This is for solar pumping system. Now, this is mainly for the supply and installation of 4,500 off-grid solar photovoltaic water pumping system across Maharashtra is what the company has indicated. Next up on our radar is DCM Shriram, the company to acquire 100% stake of Hindustan Specialty Chemicals for 375 crores. With this acquisition, company plans to enter chemical business in the epoxy and advanced materials space is what they have said. And the acquisition is expected to be completed by September 2025. Next up is Torrent Power, the arm Torrent Green Energy wins wind power project worth nearly about 2,650 from Solar Energy Corporation of India. Universal Cables will also be in focus today, as the company has said that the EU to impose countervailing duty of 8.3% on import of single model optical fiber cables is what they have indicated. Next up, lastly, NBCC, the company has been awarded a new work of Navodaya Vidyalaya Samiti across 4 states, namely Arunachal Pradesh, Assam, Manipur and Telangana. The work order is almost about 518 crore. So these are the stocks that we'll be keeping an eye out today, and I expect most DCM Shriram, Crompton, Torrent and NBCC to open in green and Universal Cable in red.
Okay, all right. Thanks a lot for that, Upasana. Well, let's hop across to Manisha, who's joining to tell us about the big spike we've seen in crude oil prices. Morning, Manisha.
Thank you for that, Nigel. Well, absolutely. This is one commodity which has absolutely surged through the roof. We are trading 10 to 11% high at this point for the crude oil prices. It's a 2-month high. Remember, the high that crude has seen in this year has been to the tune of $82. And then we saw the prices decline all the way to below 60 as well. But trading at around $75, $76 an ounce is a huge run-up that we have seen. And with the kind of run-up that we have seen in crude oil prices today, it actually has turned positive for the year 2025 as well. Well, Israel conducting preemptive strikes on Iran. The attack has set off a new conflict in Middle East. There are fears of regional wars. Israel has declared a state of emergency as it braces for a retaliation from Iran. We also are looking at prospects of a broader Middle East conflict. Not just that, there is also a threat to disruption at the Strait of Hormuz, a vital route for about 20% of global oil flows. And not just the crude oil prices, but we also are looking at the derivatives to continue to trade on the higher side as well. It is 4 to 6% of gains that we are dealing with in case of natural gas, heating oil, and gasoline prices. All of these are trading at a multi-week, multi-month highs as well. So everything that has to do with energy at this point in time is surging.
Thank you. Lots of first order, second order impact will be visible in stocks today. So on the way up, traditionally, you've got ONGC, Oil India with spike. On the way down, you've got your oil marketing companies which come under pressure. Pain stocks like Asian, Kansai, Berger, and then even some of these aviation names like Interglobe Aviation could be negatively impacted. That's the big story. We'll keep revisiting that. In fact, we've got with us Richard Redoglia, CEO at Matrix Global, now joining in. Richard, thank you very much for joining in. You would have heard our colleague Manisha laying out the turf. Share your insights. The situation is just unfolding right now, but before the details come in, we've seen that risk premium and crude prices spike.
This is remarkable. You're exactly right. This is another price spike. One that we've seen many times over the years, though. So it's not the first one. This one, though, is very dramatic because it's coming against a major OPEC partner, Iran. Iran produces around 3.5 million barrels a day. That's only around 2.5 to 3% of the world's supply, but it also sits on the edge of the Strait of Hormuz. And your prior analysis said that's where 20% of the world oil prices move through. What is interesting is that prices have been moving higher over the past number of days. Just a couple days ago, the market was up around $4 or $5. Currently, it's up almost $9. I think about almost 10% of prices. Really, this is the first time we've ever seen an attack on Iran directly. Back in the 80s, we had the Iran-Iraq War. We had the Gulf War 1 and 2. Both caused significant price spikes. And the interesting thing about those price spikes is that they were met ultimately by excess supply. And that is what's interesting about this situation we're in right now. And while the market is reacting dramatically, just like it reacted dramatically to the Ukraine war, where prices went up to as high as $120 a barrel, this too is getting another reaction. But this one is different. This one is now at a point in time where the threat of a larger regional war, and more importantly, a cutoff of oil supply by Iran to the Strait of Hormuz, is something that is a possibility. We've never seen this before. This is something that is dramatic, and it's why the market at this point in time is maintaining this high price of $7 to $8, $9. Over the next 2 or 3 days, we are going to find out what the responses and what the effects might be.
Hi, Richard. Good morning. Good to see you. And as you said, they blocked the Strait of Hormuz. That's the problem because 20% of the global supply goes there, though Iran's not a very, very big player in terms of global supply. I think it's up 2% or thereabouts. But tell us, what are you working with? I mean, in terms of scenario analysis, the last time around, as you said, crude oil prices spiked to around $100 plus per barrel. We've already seen a big move. I think in the last few hours, it's already moved $8 to $9 per barrel. Where do you think it's headed?
It is the $24,000 question. It's a great question. I think what's interesting about the world right now is we have excess supply. There currently is around 5 to 6 million of excess supply between other OPEC members. And while this rally is significant, it really only puts us back in a price range that we've experienced over the past 3 or 4 years. If you go back even longer to 2016 and 2016 to 2020, the price had a range up as high as $120 given the Ukraine war. What the market has shown over all of these price spikes, its ability to maintain higher production. And I think that is something that we have to be very careful of. And so while the market might make rally here, what is interesting, if you look at the current price of oil, around $76, $77, but then you look at the price of oil out a year, it's only $65. So one has to ask themselves, while it is a short-term oil spike, is it going to be a long-term oil move? And I'm not convinced of that. I tend to believe that the market has found a way to produce a lot more oil. And while it's important that we're going to see what the response of Iran's going to be, it's going to be hard to load tankers, and so we could be losing a couple of million barrels of oil production a day. The question is going to be 1 month from now, what is it going to look like? And one of the things we do know is that there's excess supply in the marketplace.
Richard, where is, according to you, the U.S. in all of this? I mean, it's, as many are pointing out, it's a bit of a...
Sticky wicket. Yes.
Yeah, because President Trump's last social post kind of did not indicate that there were strikes were imminent, and actually indicated to the contrary. And now this, although there are reports indicating Israel is saying through sources that, you know, they informed Washington before striking. U.S. wants to stay out of it, but will they be able to?
I think they're going to try to stay out, but I think the last thing is we'll see is U.S. militarily involved in this. I will not think there'll be U.S. airplanes flying. You know, Trump was elected on the back that I am not going to start a war. He, in fact, interestingly enough, Wyckoff, his lead negotiator, was supposed to be in Iran, or they're supposed to meet with the Iranians this Sunday. And so it makes one wonder, while Netanyahu let him know that this was going on, and one would think that if Trump said, don't do it, that would be one of the things you would think he might say, but he couldn't stop Netanyahu from doing this. It is an interesting question. I tend to believe that Trump does not want to start wars. That's one of the things, that was one of his major points here in the United States during this last election, that he would not start any new wars that the U.S. would be involved in. So
and he's promised stopping wars, but what he's also promised is significantly lower prices, oil prices. And I would say that is the one thing before this all started where he has success so far. It's still early in his term, but oil prices are down quite a bit from the time that he took over. And that is at risk now.
You are spot on. That is the exact right analysis. I live in California. It has the highest oil prices in the country, and you're exactly right. The oil prices in the rest of the United States have fallen dramatically. This will cause a price spike. It takes a while, remember, for a crude price to make its way into a product price. But like inflation, when gasoline prices and or diesel prices make a higher move, what does happen, it's sticky on the way down. So that's exactly right. This is not going to fit into his Truth Social posts, right? This does not fit into him saying, I've brought prices down. And so I've watched the oil markets literally for 46 years. I have been around for every oil move, from the Iranian war to the Iraq 1 and 2 to the moves that we've seen here over the past 6 to 10 years. This one frightens me the most because it is a direct attack on the sovereignty of Iran, which I understand where Israel's coming from. And it's really coming from, and I'm not sure if this is the case, and you guys might have not seen the news that we had here in the U.S., which was Trump has been saying for the past 4 days, he's always saying what he's going to do, right? We're going to do this. We're going to do this. He had been saying for the past 3 to 4 days that the Iranian talks are not going well and they need to be careful. And if you look at the oil price today, it's up. Well, since we have been on this call, the market was up $9. Now it's up $6.50. So that shows you the volatility. Interestingly enough, 4 days ago, the market we're up another $6 from 4 days ago. So the market has been trending in this direction. And it's been doing it in a way where it's basically been taking out the shorts, right? The shorts have been in control of this market for the past 6 months or so. Since Trump got elected, they've been in control of it. This is a shakeout of the shorts. And so we're going to have to see what this next couple of weeks is going to bring.
Okay, Richard, this was a great conversation. Thank you very much for that. He's worried. He's been tracking the crude market for the last 4 decades. He's very worried this time, but he doesn't expect a long-term durable impact on crude prices on the way up. But Prashant has now moved over to the big wall. He's talking about the big flashpoint that we're seeing between Iran and Israel and why Strait of Hormuz, the key lies with the Strait of Hormuz.
No, absolutely. And I think this is why oil prices are jumpy, edgy, and oil markets are jumpy and edgy because we don't know what's going to happen. I mean, if you think about it, we've had so many conflicts, right? But oil surges and then it's rarely stayed up for a longer period of time. But here, it's slightly different. So oil prices surging 10% after Israel has launched airstrikes targeting Iran's nuclear facilities and military command structures. Just a bit of background, right? Very near-term background. This latest airstrike, which has happened, we'll move things along. This latest airstrike, which has happened, came as nuclear diplomacy. Remember, US and Iran were talking and trying to agree on a nuclear deal. But that nuclear diplomacy was already seeming like it was on life support. The 2-month deadline set by the former Trump for a new nuclear deal has just expired. Now, the UN's nuclear watchdog, the IAEA, passed a resolution just yesterday accusing Iran of breaching non-proliferation commitments. Iran responded by pledging to accelerate its nuclear program. It basically warned that it had no option but to respond. A 6th round of talks was scheduled for this Sunday, which is day after tomorrow in Oman. But of course, by this morning, diplomacy had been drowned out by explosions, which we all kind of woke up to. Now, but beyond the price action lies the deeper, more precarious question. Could the Strait of Hormuz become the next geopolitical flashpoint? This is, I don't know if you guys can see it, if I can just sort of come through. This is the map which shows you. This is the Strait of Hormuz. And, it's basically very, very important for oil markets, as the stats essentially will tell you. It's often referred to as the oil artery of the world. It connects the Persian Gulf, as you can see, to the Indian Ocean, to the rest of, trading partners. 30% of the world's seaborne oil moves through this, 20% of global LNG supply, and most of Saudi, Iraqi, Kuwaiti, and Qatari oil exports all sort of move through that very, very narrow channel. At its narrowest point, interestingly, it's just 21 miles wide. So it's like a choke point with little room for error. Now, for decades, Iran basically has threatened, whenever tensions have escalated, that they're going to close the Strait of Hormuz. But, despite all the rhetoric and all the confrontations, sanctions, etc., it's never been closed. These are some of the flashpoints which I think we all know, at least some of the recent ones, 1980s, 1990s. If we can just quickly move this along, it's never come to the point where Iran has actually closed the strait. Let's quickly run through this. 1990s disputes with the UAE, 2007, 2008, and sort of move along 2008, a direct warning. So these are all sort of just instances, 12, 18, 19. Yet each time Iran is pulled back, right? They've threatened, but they've not closed it. Why? Because of a very simple thing, that shutting down Hormuz, the Strait of Hormuz, isn't a masterstroke. It's economic self-harm. Iran itself depends entirely on oil exports. I mean, that's basically the main source of foreign exchange for Iran. Its last major buyer is China. And if it were to shut that strait down, it would face massive supply disruptions. And it'll risk harming that most critical and crucial relationship for Iran, which is, of course, China, which is the biggest buyer of Iranian oil as well. Now, it's not just, faraway China, which is essentially the question. Even Iran's own Middle East neighbors would not be too pleased. The closure of strait would also violate international norms and perhaps fracture the fragile balance in the Gulf. Now, without the GCC support, that is the Council, Gulf Countries Council, any shutdown would be seen perhaps as an act of aggression, not leverage. Fellow oil giants, they're all big oil producers. Saudi Arabia, for example, while it can, according to experts, divert some exports via the pipeline route, but the vast majority of oil still passes through this strait. Similarly, Kuwait, Qatar, Bahrain, etc. have no alternative routes. Most of this oil, of course, is headed to Asia. China, of course, as I said, is the big buyer. These are essentially, critical for regional stability and, of course, the revenue which all this oil kind of brings in. So that essentially is the issue here. The Strait of Hormuz And if, I mean, it'll come to the point where Iran has no option but to kind of sort of, it sees this aggression as so large and so harmful to itself that it threatens to shut the Strait of Hormuz. It's never happened so far. But as they say, well, there's always the first time. We hope it doesn't happen. But I think we'll have to watch, and markets will be watching this very, very closely. Back to you guys.
All right, thanks a lot for that, Prashant. For the time being, we'll slip into a short break. You come back, we'll continue our focus on what's going on in global markets. Keep an eye out on crude. We'll also be joined by Sid Kemka, who will help us out with some fundamental analysis.
Welcome back. Let's talk about some stocks which could be in focus today. We'll get to oil and gas. We've got an expert joining in to address the individual moves in stocks. But for now, Siddharth Khemka, Head of Research, Wealth Management, and Motilal Oswal Financial Services is now joining in. Siddharth, despite the RBI liquidity boost last Friday, banking stocks have pulled back. And ICICI Bank, I think, is down about 2.5% this week, and HDFC Bank is down nearly 1.7%. So Street is clearly concerned about margin pressures in the near term at least, and the possibility whether we're going to see more rate cuts. Your thoughts on banks, and ICICI Bank in particular was on your radar on account of the monetization of its subsidiary.
Yeah, morning. So stronger start to the day after what happened yesterday. So the heart goes out to all the people and the families who lost their loved ones. I think coming to the banking sector, I think yes, the street clearly is concerned on the near-term NIM pressure. What we believe is that more than the upfronting of the rate cut, the CRR cut of 100 basis points, that will be a big structural positive for banks. Yes, there is also some profit booking on back of expectation that was ahead of.
Okay, Sid, we're going to just fix your audio, a little scratchy line, but allow us to do that. Let's just get our technical experts in as well for a quick check on, how things are looking. Mitesh is with us and so is Sudarshan. Gentlemen, great to have both of you here. Good morning. Market sold off sharply yesterday. And of course, I don't think anyone could have known what was coming this morning with this 10% surge in oil. But, 1% cut here, and then this morning, sharp indication of a sharp 200 plus point sell off as well. Mitesh, what would you do? What's the recommendation?
Yeah. So, morning, Prashant. Yesterday I was talking about the fact, in fact, day before yesterday also I started talking about this, that there is a lack of momentum post that breakout which happened. The markets, were not able to give you a good follow through, and we saw that this breakout, typically, which should see some momentum on the upside, was not moving the way it should. So I think, having said that kind of scenario, I think you always were worried that if the signals don't kind of join together, then you might have a situation when the retreat will happen, and we might even go back to the earlier lows of consolidation, which is around 24,500. I think that scenario is playing out, and a retest of 24,500, 550 in that zone, which was the base few days back, is on the cards. If we start breaking below that, we'll look at a bigger reversal. But I think otherwise, it still is a market, which possibly could get back into base building mode.
So Mitesh thinks markets are headed lower to 24,500. This morning itself, you'll get a bit of a gap up. Sudarshan, morning. So when we get a gap down today, what would the advice be?
Yeah, good morning. Well, actually, it's not a good morning. We had the very bad mishap yesterday, and then a lot of excitement today. But, one of the advantages of technical trading methods is that risk is managed. Yesterday, I had explained that the markets are giving a sense of uncertainty. So let us raise our stops to 25,000. That was a very wise move in retrospect, because yesterday trades should have been stopped out at 25,000. And of course, nobody knew what would happen today. The important part was that when we feel that risk is becoming unacceptable, we get out of the market. That happened yesterday itself. Today, there is no view at all. It's difficult to say if this is a dip, This is the beginning of a much deeper decline. It's a reaction, correction. Nobody knows. I mean, I can't say. So the trade today is do nothing, don't dabble. There will be a lot of volatility. You might end up getting burnt by that volatility. Markets could go up and down in seconds. Just step aside.
Okay, just step it aside. Fair enough. And I think that's well put, Sudarshan.
By the way, Prashant, sources say that the Genus Power block deal has been called out. Remember, Nimesh was saying about GIC looking to do that block deal?
Yeah. I was asking him. They got
in 1 year, what changed?
Got in last year and they've decided to sell. But the block deal has been called off, and I think we should have Nimesh back with more details. But Sudarshan, as I was saying, well put. It doesn't tell you exactly what to do, but gives you indications and helped you pare risk back. At least that's the call yesterday. Sudarshan, your trades for this morning.
Well, the trades are, rather than give you a stop loss or levels, I'm just giving names of stocks which are interesting. They don't have to be bought now, but traders and investors can look for positional trading ideas in them. And that starts with TCS, Divi's Lab, Bajaj Finserv, and Apollo Hospitals. Different sectors, but all of them probably could be leaders. I'll repeat that. TCS, Bajaj Finserv, Divi's Lab, and Apollo Hospitals.
Videsh, your stock calls?
Yeah. I have 3 sells and a buy. On the buying side is Bandhan Bank, which on a mild decline around 175 half, can be bought with a stop at 171 for targets of 185. Sell on Marico with a stop at 700 for targets of 670. A sell on SBI Life with a stop at 1785 for targets of 1725. And Aarti Industries is a sell. Keep a stop at 478 for targets of 450.
Thank you. We'll come back to you in other somber news. Sanjay Kapoor, chairman of Sona Comstar, a global automotive components company headquartered in Gurugram, passed away yesterday at the age of 53 after suffering a heart attack in the UK.
Welcome back. This is Open Exchange. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, we're getting the initial pre-open rates that are coming in there, and it's indicating that we're going to start off on the back foot. So the GIFT Nifty was suggesting a pullback of closer around 300 points. Now we have, in fact, the Nifty that the pre-open rates are suggesting maybe a deeper gash. So let's see how that pans out. We'll get back to that rate once it stabilizes. Sid Kemka is still with us. Hi, Sid. Good to see you, and as always, not such great times for the markets as well as for, with regard to the geopolitical tensions as well. But tell us your view. Crude oil prices have spiked. There could be various crude oil plays, whether you look at ONGC, Oil India, maybe some of these pipe makers, because, laying the pipeline will be important as well. How would you play this, on the positive side first?
Yeah, thanks, Nigel. I think a somber start to the day with what happened yesterday. So heart goes out to all the families who lost their loved ones in the Air India crash yesterday. You also have the geopolitical flare-up in Middle East that led to sharp jump in the crude oil prices. So definitely this would be on one side positive for the upstream oil companies and some of the companies which are involved in the capex theme for the oil and gas industry. On the other hand, this will be definitely negative for the downstream or the oil marketing companies, some of the company sectors that use crude as a key raw material. So within the upstream oil companies, we believe both ONGC, Oil India, that could be a key beneficiary. We are working with a crude price estimate of about $65 per barrel, and between the two, Oil India is more, you can say, directly linked to the crude, while ONGC has a fair mix of crude as well as the gas prices, so APM factor also comes in. For Oil India, a 1% change in crude oil prices impacts the profitability by about 2% in either way. So this sharp jump in the crude oil prices, we definitely believe very positive for both ONGC and Oil India, but much larger delta that we'll see in Oil India going forward.
Also, as you rightly highlighted, some of the other companies, for example, Engineers India, that does a lot of EPC contracts plus consultancy for the upstream oil companies, that could be in focus. On the other hand, as we said, OMCs could be under pressure.
OMCs should be under pressure. So upstream up and downstream down. That basically is what Siddharth is essentially laying out. Siddharth, any thoughts on Genus? Genus Power, the smart metering story. As we were discussing earlier with Nimesh, GIC got in only last year, invested in the company, put money into a platform, an SPV, and they were going to go big in terms of execution on these smart meters, etc. And there was a block which was scheduled for this morning, and now the block is cancelled. I don't know if you have coverage per se.
So Prashant, unfortunately, we don't cover Genus, but I think this entire smart metering segment looks attractive. A lot of companies in the EMS space have also got into, including the likes of CG Power. They've got a plant in Hyderabad up and running recently, which is where we have a coverage, but definitely an interesting space. We don't have view on Genus, unfortunately.
Okay, you don't own Genus. The other stock I want to just quickly get your views on is BSC, Siddharth. One-way move, and then day before yesterday, there was a bit of a cut, and I think it's corrected about 10% or so from the recent highs after a one-way spectacular move. Any thoughts here?
So yeah, I think while we continue to have a positive view, the valuations have definitely skyrocketed and surprised us on the positive side. I think there were some technical factors as well on the exchange where NSE put the stock under ASM, so that also led to some profit booking. Overall, we believe that there is a lot more clarity coming in the weekly derivatives contracts, the expiry days, and that is definitely helping the positive view on BSE. Also, that what we are also seeing is that there is a lot of interest in the unlisted space in NSE as well. On back of that, we are seeing recovery in the overall volumes on both BSE as well as NSE, that is leading to the sharp uptick. But yes, at this valuation, I think definitely the stock needs to consolidate. We could see some time correction, but long-term view is positive.
Siddharth, thank you very much for joining in. Let's focus on the oil and gas stocks now. That's the big story, the spike of 10% in Brent and WTI. Dayanand Mittal, oil and gas analyst at JM Financial, is now with us on the show. Dayanand, hard to say how this will play out, but just let's start with the sensitivity. If there is a $1 increase in crude prices, Brent, for instance, how will it impact the upstream companies, the downstream companies, and even if there is a second-order impact on account of the subsequent increase in gas prices, etc. So let's start with, putting the sensitivity on board.
Yeah. Thanks, Rima. So for every $1 increase in crude, given now there is no windfall tax, so there's no cap on ONGC and Oil India's realization. So every $1 increase in crude has a positive impact of 1.5 to 2% on ONGC and Oil India's EPS. And for OMCs, on the marketing business, so every $1 increase in crude reduces their auto fuel marketing margin by 50 paisa per liter. So so when crude was around $65 to $70, they were making about 10 to 12 rupees per liter. Now, as per our calculation, at 77, 78, that has now come down to around 3.5 rupee per liter. Now, this is in line with what they've been earning historically, which is 3.5. So they were enjoying a very strong margin last few months, and now that has got normalized. Now, every 50 paisa lower marketing margin has an impact of about 7 to 8% on OMC's EBITDA. So last 4Q and probably this quarter, OMC's EBITDA would have shown very strong growth. Probably this spike in crude will mean 2Q onwards, there could be downside risk to the current earning trend.
Hi, Dayanand. Good morning. Good to see you. And just to get that number out of the way, with regard to OMCs, their margins for the past quarter were how much, for the initial 2 months, because everyone's bracing for a very good set of numbers coming in there. But now, post this price spike, if I got that number correct, it's come down to around 3.5 rupees, right? Yeah. But prior to that, what was it?
Yeah, so for 4Q FY25, the quarter which was already reported, the auto fuel marketing margin was 7 rupee per liter.
Correct.
In 1Q till date, our calculation suggests it would be in the range of about 11 rupee per liter. This is before yesterday's jump in crude. Right? So this 11 rupee for roughly 2.5 months in this quarter. On spot basis, that margin has now come down to 3.5 rupee per liter.
Got it. And in your calculations, where are you at in terms of foreign average? Because even at 10, 11 rupees, I don't think you'll be factoring in that sort of a number for the year. So on an average for the year, what are you working with?
So for FY26 and 27, we were working with 4.2 only. And we were assuming LPG losses would get compensated. So if I have to adjust for LPG losses, then I was working with 4.2 plus 2, so 6.2.
Okay, all right, 6 months, got it. So, and with regard to the movement that you're seeing, as you said, the sensitivity analysis for both Oil India as well as ONGC could spell good times because of the move that we have seen on crude oil prices. What are you factoring in on crude oil prices for the year? And in turn, what is your current call both on ONGC as well as Oil India?
So yeah, so our assumption was, we were factoring in crude price about $75, let's say 6 months back. But given the demand concerns and tariff-related uncertainty, 3 months back, we had brought it down to around $70. So $70 is what's our current Brent crude price assumption for all the coverage universe. And hence we had a positive view on ONGC All India because at CMP, both the names were discounting more like $60 to $65 net crude realization. So there was a decent 15-20% upside, and if the current crude price was sustained, the upside, there would be additional upside to our target prices.
So you continue to remain positive on both these two, while on OMCs you have a negative stance?
Yeah, so on OMCs we have a negative stance primarily on valuation ground. So they're trading at 1.3, 1.4 time price to book. Historical is 1. And our key structural concern on OMCs is the huge capex which they're doing, which tends to be value destructive in long term because of the significant time and cost overrun.
All right. Then I'm sure my co-anchors have some more questions with regard to these stocks. But just from an India perspective, the dependence on Iran for oil had come down drastically. As of now, it's zilch. I mean, no dependence.
Yes, nil. Because of US sanctions. So India can't buy crude from Iran.
And most of the crude that's produced in Iran goes to China.
Yes, out of 3.4 million barrel per day which they produce, 1.4 odd is exported. 90% of this export goes to China.
Got it.
Yeah, no, absolutely. Our dependence on completely unrelated, but Russian imports is also the last I checked has become very, very small, compared to very large numbers earlier. There, sorry, you want to comment there, Anand?
Yeah, not really. I think Russian import continues to be strong. It declined for a month in March, but then it picked up in April and May. So Russian imports are about 35 to 40% of our imports. Yeah.
No, I'm saying it had risen far higher. You're right. I mean, I checked with the oil marketing companies, I think the weekend before, and it's in that 25-30% kind of number. But of course, I mean, it's a big drop-off compared to where we were earlier. Oil marketing companies and stocks, Dayanand, what is your view? Let's just assume for a minute that this flare-up is just that, a flare-up, and then things settle down. So we had that Libyan disruption. Prices did not rise too much. There was a Saudi disruption that, of course, was significant but short-lived. So let's just assume for the purposes of this discussion that this is short-lived as well. Beyond this, how are OMCs stacked, and what's your view here?
So structurally, we are not so positive on OMCs. One, on valuation ground, they're trading at 20-30% above historical valuation on price to book, 1.3, 1.4. And our key structural concern there is the huge capex spree which they are in terms of setting up refining capacity, where there's a lot of terminal value concerns, and also petchem, where margins are quite at tough levels. And most of these capex tend to see significant time and cost overrun, and hence tends to be value destructive. So probably buying OMCs when they're trading sub one-time book is where we are comfortable with. Buying at 20-30% above price to book, I think the risk reward is against you.
No, absolutely, and I think that's the we got to buy it cheap, really cheap. That's the basic message, right? These kind of names.
Yeah, completely.
Yeah. And which is not the case right now.
Which is not the case right now.
Okay, and of course risks are also slightly higher. With all this which is happening, do you have coverage on some of the gas stocks, Dayanand? Any thoughts here?
Yeah, so we have a positive view on GAIL, which would be a beneficiary of high oil price. We also like Gujarat Gas, but it's more on the assumption that spot LNG prices moderate to more normalized levels in next 1 or 2 years with a lot of LNG supply capacity coming in. CGDs, apart from Gujarat Gas, IGL, MGL, we have a negative view on structural concerns given the APM allocation cut and EV related impact on volumes. Yeah, so Petronet also we are not very positive, primarily because of their capital misallocation concerns on petchem side.
Yeah. Okay, Dayanand, thank you very much for joining us. Really useful conversation this morning. We've got the market open coming up. We'll look at indices and we'll go down to stocks. It's a sharp cut, 1.5%. So 24,552 is where we're at. So you're basically we've opened at the lower bound of the support zone, which is the 40-day exponential moving average. So 24,500 is that number. I think we hit it. And we're around it now. So 24,570 or so on the Nifty. So about 1.25% lower. The Bank Nifty is down 1%, 55,495. The mid-cap index is down about 1.6. And I think the small-cap index, of course, also down similarly. The thing is, it's a weekend. The news flow indicates so far, at least, from Israel that, this is going to go on for a few days. So it's not like a short-lived operation. They're saying, well, it could go on for several days till their objectives are achieved. So there is the weekend risk, which also suddenly starts to appear in a meaningful way. But we'll see. You're at the lower, the first support zone, actually the second support level, which we mentioned in the morning, which is the 40-day exponential. Let's see if you're able to hold on to it with this 1.4, 1.5% kind of cut. Heat map on the Nifty, I think, should be predominantly red. Only one name, upstream, ONGC is high, everything else is down in the red. Rima.
Indeed. So ONGC is up 2.5%, but that's the only Nifty stock which is currently in the green. But you've also got green in the form of Oil India. So talking about the only beneficiaries of the spike in crude prices, ONGC and Oil India. But on the way down, oil marketing companies, 4% gone. BPCL, HPCL, IOC. Aviation names, look at Interglobe Aviation and SpiceJet, both of them down nearly 4 to 5%. And Sona BLW Precision, Sona Comstar, where the promoter, Sanjay Kapoor, unfortunately, in tragic news, has died of a heart attack. The stock has taken a bit of a knock. Outside of that, in the large cap action, you've got L&T, weakened trade. That, in fact, is the top Nifty loser. Adani Group stocks are correcting. Adani Ports, Adani Enterprises have a cut of about 2.5%. Some IT names are on the back foot. So Infosys, Tech Mahindra, subdued. Shriram Finance also down more than 2%. Throw in a couple of auto names where you're seeing red on the screen like M&M and Bajaj Auto. Now you've got Apollo Hospitals, which is nudged back into the green. But again, the gain there is pretty insignificant. 0.1% on Apollo Hospitals, but predominantly red. The good thing is the Nifty is holding on to 24,500. In fact, as we speak, Nigel, almost at the 24,600 mark. And the mid-cap fall is about 700 points, so in line with the large cap.
Well, that's right, Rima. As of now, you have only 140 stocks that are advancing on the NSE. By the time we wind up today, you'll want to see far more number of stocks that are advancing, though the global picture is still very, very skittish. A few stocks that catch your attention. IRDA, that's under pressure. I think the QIP allotment has come about, so that explains why that stock, in fact, is lower in trade. So a sharp downtick is what we're seeing out there. But otherwise, some oil-related, exploration-related names are doing well. Ceylon Exploration is up close to 2.5%. You mentioned Oil India, you mentioned ONGC as well. That stock as well is doing quite well. So those are a few gainers out there. Another stock that's moving up is Innova Captab. I think, we don't talk about that stock very often, but that stock, in fact, is higher in today's trading session as well. The ones that are getting pounded are the OMCs. You have the paint-related names as well as aviation stocks. All of them are losing out in trade as we speak. So a subdued start. Canara Bank is another one that's down close to around 5%. So keep an eye out on that name. A soft start on expected lines. Hopefully, by the end of today, will be higher than what we saw at the start.
So already, I think about 100-point lift coming through on the Nifty from the opening levels, which was around the 24,500 kind of mark. Pretty big surge in terms of oil is what you have. That's Prime Minister Modi visuals coming in. And I think, we'll have more on this as we kind of sort of go along. But those were visuals of Prime Minister Narendra Modi coming through. This is, of course, he's at the civil hospital in Ahmedabad. Tragic incident yesterday, and just a complete tragedy in that sense. Let's just welcome in Manishi Chaudhary, who's with us with just what he's making of things here. Manishi, good morning. Great to have you with us on the program. I think the big talking point, of course, is the big surge in oil. No one knows how this kind of goes. If history is any suggestion, it's short-lived. The spikes are short-lived, even if they are sharp. So I guess you just got to go with that. If the Strait of Hormuz, as we were discussing, is closed, then no one knows what will happen. But what's your sense? How do you assess risk-reward from here for markets broadly?
What's happening today, the reason for that is obvious. I mean, we've pretty much all the Asian or emerging markets down anywhere between 0.7 to 1.2%. And it's a direct fallout of the increasing geopolitical tensions in the Middle East and the consequent increase, the spike in oil prices. Now, one doesn't know how long this tension would continue. One can only hope that the military tensions die down or are resolved, pretty soon. But, honestly, these things are completely unpredictable. So in the near term, we obviously will have to tighten our belts, brace for more volatility, but that's the only thing I guess one can say from a fundamental perspective. If you look at the longer term, once these military tensions are behind us, then emerging markets and in particular Asia have a lot going for them. There are quite a few tailwinds that have aligned together. We have seen the US dollar weakening, and that's actually likely to continue for some more time. And as a consequence, we are seeing the Asian central banks getting a much higher degree of confidence in injecting monetary stimuli through rate cuts and reserve ratio cuts. The most recent example is the RBI, which actually front-loaded these actions. So, we have quite a few things going in favor of Asia. The only thing that I think still needs to fall in place is an earnings estimate recovery, which was beginning to happen for a brief while in late 24 and early 25. But the earnings estimates are coming down again, except for, I think, a few markets like Korea and Taiwan. We have seen earnings estimates decline, and that's true of India as well. So I think we need that earnings picture to stabilize. Hopefully that'll happen once the impact of these monetary stimuli hit consumption and investments, possibly in the second half or maybe in the last quarter of this calendar year. But till then, we will have to be prepared for a range-bound movement of equities in this region.
So markets are range-bound. Manishi, hi, Rima here. So how are you positioning yourself now in the Indian market? Take us through your portfolio and your big bets.
Right. So we have an Asia ex-Japan model portfolio, which we recommend to clients. And we actually have an overweight stance on India on that. So compared to a benchmark weight of close to 20% for India and MSCI Asia ex-Japan, we have somewhere around 23 to 24%. The largest weights in that portfolio are the private banks. I have been harping on the private banks for quite some time now, and that stance hasn't changed. I mean, if we're going to have growth in investments and consumption, that'll have to be financed largely by the private banks, which are gaining in terms of market share. Second, we do have consumer discretionaries, and that's a combination of both automobiles, particularly four-wheelers, and some of the higher end premium consumption, like jewelry. I would also add some of the tourism related names to that bucket. Third, we have some exposure to the IT services that's more tactical than strategic. We think that the valuations are now in favor of investors. And if we do have, the US corporate performance turning better, particularly for banks and, the other service sector, that would have a positive tailwind for Indian IT service companies. Yeah, so these are some of the the important exposures that we have. We also have some exposure to telecom, petrochemicals, the conglomerates that you can think of. I'm not going into any names, but it should be obvious. So that is really our India exposure in our portfolio.
Hi, Manishi. Good morning. Good to see you, Ben. It's a bit of a subdued start to trade, both for the markets globally as well as emotionally. But, at times like this, when you have geopolitical tensions that rev up yet again, it provides opportunities at times. And one sector of the market that's been getting a lot of attention is the defense space. Some of those valuations have gone, out of whack. While there's a counter argument that there's going to be increased focus, increased spending on the defense side of things. So these companies ultimately, the earnings will catch up to these prices. What's your view on it?
So defense sector is something we like. In fact, in response to Rima's question earlier, there's one sector that I did not mention is industrials, where we do have significant exposure in our portfolio, and that includes, some of the dedicated defense names. The problem in the sector is valuations, because a lot of significant growth expectations going forward have already been factored into the prices. So, even if those lofty expectations are realized, and I'm not saying that they won't be, but even if they are realized, the valuations may not really move much higher. In fact, we may have some kind of a plateauing of the valuations and share prices for a while. I would not expect these stocks to decline significantly on an absolute basis. But what you may see is, what's called a time correction in this sector. So investors would have to be a bit careful in terms of valuations when adjusted for future earnings growth when picking stocks in this sector.
You said India's weightage is 23% versus a benchmark weight of 20% in your portfolio right now. What's the most in terms of, India's, what's the maximum that you're willing to go? Is there more headroom for you to up your exposure to India?
Right. Now, that's an interesting question. I think that willingness would come once the headline valuations, particularly the relative valuations of India, narrow down a bit. This was actually the situation sometime in March. Indian valuations peaked out in September, then for about 6 months, they drifted downwards, while North Asian valuations, the North Asian markets outperformed India. But since then, we have had another spike in Indian markets, Indian valuations. So that relative valuation gap, which had narrowed down, has opened up again. Now, of course, I think over the last 1 week or so, we are seeing another round of pullback in India. And simultaneously, there are some North Asian markets like Korea, which have spiked strongly. So I'm hopeful that that relative valuation gap may narrow down again, possibly in the second half of this year. But, India's valuation premium to Asia, which is somewhere between 35 to 40%, that's the long-term average, it would really needs to come down there. Currently, it's somewhere around 50 to 52%.
Got that. 50 to 52% is India's valuation premium. So you laid out some sectors that you like. Large private banks, you've always been bullish on that. Some consumer discretionary, which includes jewelry. Some, I think, tourism names, industrials, which has defensive, and a tactical bet on IT. At this juncture, if you have to put incremental money to work, which sector would you buy right now?
Well, one easy way of responding to that is, buy more of, what we already have, or buy more stocks in the same sectors where we are exposed. But there's one sector, if I were to look at the sectors that we don't have exposure to, which we are avoiding at this point of time, the most prominent one is consumer staples, where we clearly think that the valuations are not in favor of investors when one looks at the future earnings growth. We also don't have metals and mining, but that is something one has to look at carefully because I think some of the some of the metals and mining exposures, particularly say in copper, could actually do better if we do have kind of a broad-based improvement in infrastructure investments. Copper is one of the biggest barometers of that. But broadly, I think our sectoral allocations would remain unchanged, even if we were to, sort of allocate more to the Indian pie.
Point taken, Manishi. Thank you very much for joining us. It's a pleasure having you here on CNBC TV18. Good sort of contextual regional commentary with, of course, India at the center of it. 24,625 is where the Nifty is at. So we're off about 120 points off the lows of the day. Lows of the morning, really. 10:1 is the declines to advances ratio, and maybe we'll look at this in a bit from now. Look at, there are, of course, with regards to airlines, etc., there's, of course, a tragic accident yesterday. And then this morning, there is also this 12% surge in oil prices, and we're going to talk about both of them. But let's talk about the tragedy first. And our colleague Madiha went down to Ahmedabad. She's in Ahmedabad right now at the crash site with, of course, what's happening, what's the latest update, and what she's picking up. She's, of course, been speaking with many aviation experts to try and figure out what really happened. But tell us, Madiha, morning.
Hi, Prashant. We are currently at the crash site, just meters away from the crash site, and the area is now barricaded. The journalists or other visitors are not allowed because we also had the Prime Minister moments ago visiting the crash site, talking to officials, talking to investigating teams. He's also now headed to the hospital where the injured are being taken and there are victims' families there, so he's going to speak to them. What you see behind me are the 4 buildings, and the last building, the 4th building, is where the plane crash landed. It was a Boeing 787 Dreamliner that was operating flight AI-171, Ahmedabad to London. The flight had crashed in seconds after it took off from the runway. There were 242 passengers on board, including 2 pilots and 10 cabin crew, and only 1 passenger miraculously survived. Remember, the flight was carrying 125,000 liters of fuel because it had prepared a journey to London so that the tank was full. And when it crashed, just seconds after the takeoff, it exploded into a huge flame, resulting into almost no survivors, and only 1 survivor, 1 passenger, miraculously survived, and he's believed to have jumped off the emergency gate that was next to his seat. So 242 passengers and 1 survived. That included 2 pilots and 10 cabin crew. So a very, very tragic moment for India. It is also a big global tragedy. It's a 787 Dreamliner, and the first fatal crash for a 787 Dreamliner. The Boeing planes have had history of air accidents in the past, but they were all 777s, Boeing 737 NG, 737 MAX, and 747. But a 787 Dreamliner has never been involved in a crash or a fatal crash. Never, and this is the first of its kind that it has been involved in such a crash. Also a major tragedy since 2023. In 2023, we had the Yeti Airlines crash in Nepal. It was a turboprop plane that had led to the death of over 60 people. In 2024, we had the Azerbaijan Airlines plane crash and the Jeju Airlines plane crash at the Muan airport. In 2025, Air India plane crash in Ahmedabad becomes the major tragedy, not just in India, but also globally. We continue to track the developments. We are being told that the casualties, apart from the passengers, the number of deaths are high because the plane crash landed at the hostel of the medical college, and there were students, there were doctors who were inside the campus. There are deaths there, there are injuries there, but we are still to confirm how many deaths, how many casualties are seen at the hospital.
And we'll keep coming back to you, for those updates as you get updates from, the hospital and, what is the latest situation out there. Thank you very much, Madhiya, for that update at this point in time. I think we got some visuals coming through. Prime Minister Modi actually now coming out of the hospital, the civil hospital in Ahmedabad. There you go. We'll just, I think, Prime Minister arriving this morning to the hospital, meeting survivors and the injured. Of course, from the flight itself, I think is being widely reported. There's only one survivor, but those are visuals essentially which are coming in. We also spoke with N. Chandrasekaran, chairman of Tata Sons, and of course Air India as well. And my colleague Shireen spoke with him. N. Chandra calling this the worst professional sort of day of his career. Listen to that soundbite.
It is a totally devastating tragedy, and we are all totally shocked and deeply affected. And our immediate focus is to help the people, the families of people who have experienced this tragedy. We are working through that at this point in time. We are trying to set up all the support systems, the emergency helpline number, and on-the-ground support. A lot of people from Air India have flown from Delhi to be here on the ground. So we're creating all those infrastructure. While we are trying to do all of this, we are also working with the authorities to see the investigation and the root cause, etc. I have spoken to the CEO of Boeing, and I've also asked him to send the best expert to work with us in this whole process. To help the families, we just announced that we will provide 1 crore for each family of the person who lost their life. And also we will be providing all the medical related expenses for all the people who are injured. And we will also try to help to rebuild that infrastructure in the hostel where the crash actually happened. It is the worst day of my professional career, I can tell you that.
Well, that is N. Chandra, Chairman of Tata Sons and Air India. His comments there reflecting, of course, the general mood out there, which, of course, is pretty down and out after the tragedy yesterday. Kinjal Shah is with us, co-group head and senior vice president at ICRA. We also have Mark Martin, founder and CEO at Martin Consulting. Gentlemen, good morning. Great to have both of you here. Thank you very much. Mark, let me come to you. Just on, this is an aircraft, of course. And by the way, as I understand it, Air India already has, I think, about 20 or 25 pending orders for exactly this model of the aircraft. Is there a need, while we wait for what exactly happened, and I think it'll come out during the course of the investigation, will this lead to a bit of a reconsideration for this specific model across the board?
No, thanks for having me. I've come on CNBC in much better pleasant times, and it's unfortunate that we need to respond on possibly the worst ever air disaster in 30 years in aviation, at least modern history. The 787 worked great with Air India from 2011 to 2025 till this day. The 787, now granted, has had maintenance issues, has reliability issues, has had maintenance quality issues, but never has the aircraft broken up or never has the aircraft structurally failed. And what we've seen here clearly is that the aircraft took off. He was at 600 feet. He was getting into his climb phase. He needed engine thrust, and the engines let him down. So now, what would have improved the survivability of this? Well, guess what? Those who have traveled to most parts of the world know this very well, that airports are deliberately kept at least 60 kilometers away from city and urbanization. So when you take off, you have just fields and fields and fields. So even if you were to bring the aircraft down, we're just going to bring it down on a soft field. But with urbanization, we've actually created these huge mega office blocks, buildings, offices, residential plots, apartments right next to the airport. So there's no chance in hell that any aircraft can even recover from an engine flame out or an engine failure. Fundamentally, the 787 is a pretty good aircraft. It flies in over 40 airlines across the world. India was the launch customer for the 787-8. It was an iconic aircraft. It still is. It's one of the most advanced aircraft out there with fiber optics and a servo on board. Air India mastered operating that aircraft. The pilot had 10,000 flying hours. One of the finest aircraft in terms of cabin quality. I'm gonna raise one question here, and let's not dodge this bullet. This incident happened after 2021 when Air India was transferred over to Tata's and Singapore Airlines. I mean, we all criticized Air India when it was under government ownership that Sarkari airline hai, Sarkar hai. But guess what? It's a private airline for 4 years. And Air India, since 4 years, continues to have not just this, but subtle, sublime violations from pilot, crew, training, maintenance. The DGCA has fined Air India the highest. Till today, I mean, you know the reviews as much as I do. Aircraft quality is lousy. The maintenance quality is bad. I mean, this is under a private Air India. So let's come down to facts over here and be factual. This crash has happened to an Air India that's a private Air India, not a government Air India. And enough is enough. I think clearly, and this investigation, before I finish, just give me one more minute. This investigation no longer is going to be smoke and mirrors with the government and AIB and DGCA. This is a global affair. The world's first 787 crash. So we have the NTSB, we got EASA, we have Transport Canada. Every investigating agency has sent over a representative and a delegation to find out what happened. And it's high time we have accountability. The government of India, Mr. Modi, the ministry, Mr. Naidu, they need to start sharpening their knives and crack the whip, because enough is enough. It's a private airline. We need to hold Air India accountable. We understand we're all mourning. It's a tragic situation, extremely sad. My heart goes out to everybody, including the airline right now at this moment of grief. But we need to get to the bottom of this, because we cannot have this anymore. And the worst part is, guess what? Air India has the word India in it. And I don't like to see my country and my name and the name of my country involved in such a crash. And I think it's high time, like I said.
Just Martin, allow me to come in, and I completely agree that we've all had, it's a consumer business, so we all know people who've had lousy experiences over the last few years, right? International flights, seats are broken. I know friends who've flown, seats are broken, all kinds of issues. Even people flying, business or whatever, it shouldn't be that way for any class.
And here's something, it's been more for the last 5 years. After 2021, it's got accentuated to a point where, passengers can't bear it. I mean, let's face it. From, to India in 2011.
Yes.
And we were angry with Air India for other reasons, right?
Yes. And you're absolutely right. We used to criticize the airline when it was, as you said.
Exactly. Yeah. It was never a product quality. We were angry for airlines for customer services, bad service, blah, blah, blah. But and the aircraft held together. It was a good aircraft. But today, Air India, the Air India that we see today is cosmetic. It's just
But my question is this, Martin. Are you pointing to, these issues inside the aircraft? I mean, basically coming from lack of maintenance, upgrade or whatever. Are you linking that with the general attitude, which perhaps may have, cost in some lack of maintenance?
You're absolutely,
because is there a link between that and, of course, something like this happening?
You're spot on. I think that's exactly it. And not just that, let's also link the whole objective of the management position on this whole airline. The first thing you do when you take over Air India is you should have cleaned the skeletons in the cupboard and sorted out the fundamentals and reinforced the basement and foundation. You can't just do a branding on the top and hope like hell that everything improves. It's never going to happen, guys. We've seen it with Tata Motors in the past. We've seen it with how many transformations in the past. Tata Steel. Air India is experts at doing this. They earned their PhD business transformation. And to see Air India, it's been 4 years, to see the Tata Group and Singapore Airlines, mind you, fail at turning around Air India, 4 years. It says a lot, and this nonchalant attitude, you're right and you're spot on. You've said it the way it is. It's high time that changed now. And it's high time, somebody rolled up their sleeves, got down and dirty, fixed that airline ground up. Because, we cannot see any more of this. Air India is planning an IPO in 6 months, in about a year from now. So this messes the whole thing up.
Yeah, no, absolutely. Although I want to also point out that we don't know what caused the accident. But take your points on, the quality and the customer service and the experience, etc. I completely take that point. But what I'm saying is we don't know whether we can link that to what caused the accident. I mean, I think we need to keep that in mind as well.
I agree. I think we should not speculate. Let a full-blown investigation come out.
Absolutely. Let's just get Kinjal in as well. Kinjal, thanks for waiting. Your first thoughts on what's happened and, how do you look at this from an aviation sector perspective now?
Obviously, this has been a very unfortunate incident, which no one would want to happen. We've seen certain such incidents happen in the past as well. But when I talk from the industry point of view at this point in time, obviously such incidents do have some impact on the overall supply of aircraft that could come in the near term. Because there would be certain checks at Boeing level and at the airline level that would keep on happening. And when we saw incidents with Boeing 737 MAX happening in the past, we did see that there were issues in terms of delays in delivery of aircraft, and the industry overall did face a supply issue. And this also comes at a time when the industry is anyways struggling with supply issues because of the aircraft on ground, because of the Pratt & Whitney engine issues. So roughly as on March 2025, we had around 16% of the fleet of the Indian aviation industry being grounded because of these P&W engine issues. Obviously, it's lower than the earlier numbers when the issues started cropping up, but the recovery or resolution is still happening. And we need to see that how supply gets impacted in the near term. Currently, in a scenario where the aviation industry demand is expected to continue to be very robust. So FY25, we ended with roughly 7.5 to 8% growth for the domestic aviation industry. And ICRA estimates that FY26 also would see a similar 7 to 10% YOY growth in domestic passenger traffic. So in such a scenario, the supply of aircraft is going to be very critical to help service the demand for airlines.
Kinjal, what does this mean for the other Indian airlines? Say in Interglobe Aviation, how does this fallout, this tragic incident, reshape the entire aviation sector in India? Can it hurt AI?
See, it's difficult to comment on airline specifics because, like I mentioned earlier, that we've seen these issues crop up in the past. Obviously, resolutions take time, and the industry takes time to come to the path of steady recovery. But despite these issues in the past, we've seen industry recover gradually, and that's what's going to be the expectation going forward as well, that there would be certain solutions which will come up, and we could probably get over these situations at the earliest.
Okay, all right. I think, it's a conversation we'll continue to have. But for now, we'll say thank you to both of you, Kinjal and Martin. Appreciate you coming on today to talk about this particular issue at this point in time, the accident which has happened. Hopefully, we'll get answers sooner rather than later in terms of what really went on. I just want to take a quick look at the market right now. 290, 300 points lower is what we have. So 24,600 at this stage. Nigel, I think we have the next management with us.
Well, that's right. Let's talk about City Union Bank. The board has approved a 500 crore fundraise via the QIP route. Let's talk about more of this and also how they see business for the remainder of this year. We're joined by Mr. Kamakodi, the Managing Director and CEO at City Union Bank. Hi, Mr. Kamakodi. Good morning. And good to have you on the show, sir. Give us a couple of details. This QIP, it's an enabling resolution. Could you tell us, why you looking to raise this money? And by when should we should see this money being raised?
It's only an enabling resolution, and we used to have this as the part of our annual shareholders meeting to get the shareholders approval and get that approval in place, if at all it is required. We don't have any immediate plans on hand to go for capital raising at this point of time. In fact, we have been having this as the part of shareholders approval for the past maybe about 14, 15 years. And we used it only once, and we are having a Tier 1 capital adequacy ratio itself in the excess of 20%. So we use it if at all we get any, let's say, opportunity or let's say the offer which we cannot refuse. So at that point of time, this will be in handy. So as per the regulations, if we get shareholders approval once for QIP, it is valid for 1 year. Okay. So every year we get this approval from the like say shareholders, and we use it only when it is absolutely necessary.
So as of now, it's just an enabling resolution. You may or may not raise this money, right?
Exactly.
Got it. All right. Let's talk about business then. How's business shaping up? I think you were guiding for around mid-teens loan growth, credit growth for this year. Do you stick to that? And now you've got a bit of a booster shot coming in with that CRR cut. How does it change things? Do you get a little bit more optimistic? And also in terms of NIMs, I think for the last year you clocked around 3.5, 3.5, 3.6% or thereabouts. Given that you have a couple of repo rate cuts as well, how do you see this pan out in terms of the yields coming in a little bit lower? And in turn, what does it mean on the NIMs front?
See, actually, like we are continuing with our past guidance of mid-teens, whatever we communicated to the market. We hope we'll be able to, let's say, achieve that figure, and probably, if possible, a percentage point more or from the points which we guided. We are trying to work on that, and it is going as per our expected planning. On because of the rate cut, as you know, like when we get into the increasing interest rate scenarios, the asset gets repriced quickly. Liabilities take a little bit longer time, and you have expansionary margin. But at the same time, when you get into the decreasing interest rate scenario, some sort of let's say the assets gets repriced quickly, and liabilities once again take a longer time. So there used to be a little bit contraction in the margin. But this time we expect a similar behavior. But the good part is that since it has come in a single shot, even though there could be issues maybe for a quarter or so, year as a whole, we expect whatever net interest margin we achieved in the past and we guided, we hope we should be able to achieve those figures as we for the year as a whole, even though there could be 1 or like say 3 to 4 months of contraction. But since it has come in one shot, I hope we will be able to, year as a whole, we will be able to maintain whatever we have achieved in the past.
Just in the near term, sir, Q1, Q2, when there will be NIM compression, what could the NIMs drop to?
As we had already guided in our conference call after the, let's say, March quarter results, what we had about, like say, 3.5 to 3.6 percentage in NIM. We should be able to have maybe about 10 plus or minus 10 basis point to start with. We had already taken certain steps, like for example, one of the major steps was that on a gold loan, which constitute about 25% of our book in the last year itself, we converted that as the fixed rate product and not a floating rate product. These things help us to moderate the shock, and also the rate, the deposit rates are also getting repriced quickly, which will help us to have, like say, having that passed on, like say, quickly. So we hope maybe about 5 to 10 basis point this way or that way.
Not significant. So then about gold loans, you said it's about 25% of your portfolio right now. Yes. What percentage of that would come in the small loans category, sub 2.5 lakh, for which the RBI has eased norms, where you can lend up to 85% of the value?
Almost 75% of our gold loan book are coming less than this, about 60 to 70% coming below this less than 2.5 lakhs bracket. But at the same time, we don't have any immediate plans to increase the LTV to 85% at this point of time, because like say there are multiple concerns are raised about how the gold price can move forward and all. We are continuing with our existing LTV. We will take appropriate call as the time progresses.
All right, Mr. Kamakodi, final question before we let you go. You've been talking about your unsecured book, growing that. But from an industry perspective, do you believe that the worst in terms of pain in that segment, is it behind? If you could give us your analysis on that, I think you want to grow to around 5% of your book. You could give us a number or there. And also, one point that the street always looks at with regard to your bank is what is the targeted ROA? Could you tell us where do you see that number headed?
See, basically on the unsecured book, when we said 5%, it is on 3 to 5 years of, time schedule. We are very slow and measured, in particularly when we are increasing our unsecured book. And whatever book we have built in the last year or so, it's holding well and we don't have any issues. And we are not rushing anything, particularly on the unsecured front. So we had, achieved an ROA of 1.5% book, and we hope for the current year also we should be having our ROA in around the same range as we had already demonstrated, maybe plus or minus 5 to 10 basis points.
Okay. Thank you very much, sir, for joining in. Moving on now to the next topic of discussion. The Finance Ministry has clarified on reports about the possible introduction of a merchant discount rate, MDR as we call it, on UPI transactions, saying they have no plans to levy MDR charges. Paytm share prices took a big knock yesterday, the single biggest drop since February of 2024. On this clarification, strong clarification coming in, I think the stock price was down about 5 to 6% yesterday. Let's get that up once again, the Paytm share price. Pranav Gundapale, the senior analyst India Financials at Bernstein, is with us, and in a bit, Abizar Divanji will also be joining in. Pranav, for now, it's a sentiment knock, but does this alter your earnings expectations for Paytm and even PhonePe? They're planning an IPO, perhaps, in the near future. Will this affect the prospects of PhonePe?
An MDR on UPI was never a base case scenario for us, and therefore was not modeled into our numbers, and therefore our numbers for Paytm doesn't change. And we've always held the view that MDR on UPI is a very low probability event, almost unlikely, not just because it's a populist move, but more because the ecosystem as a whole has seen significant benefits from the zero MDR and therefore the exponential growth in cashless payments. And it would not be wise to risk that growth in the pursuit of charging MDR, right? So I think as a system, the benefits are significant, be it in terms of reduced ATM transactions, increased credit opportunities for banks or payment players, or reduced printing costs for currency printing costs for the government. So the overall benefits are already significantly higher than whatever revenue could be earned through MDR. Therefore, we don't see a possibility of it coming through. And for Paytm specifically, I think they are close to break even. We expect them to break even next quarter, even without an MDR on UPI. So we don't think that changes our outlook on Paytm per se.
Gentlemen, morning, Pranav and Abizar. I think, so Pranav's point is clear. This MDR on UPI reintroduction was never in his base case. And the benefits of keeping it free far outweigh any collections, etc. Right? And in terms of collections, the Payment Council of India, etc., have said that government incentives are about 1,500, but the cost of maintaining UPI-related infrastructure is about 10,000 crores. So there is a big gap in that sense. Abizar, your thoughts on this issue? And was this a realistic assumption to begin with? I mean, is there a need to do this? Once this became free, UPI, of course, has become the payment of choice. If you reintroduce or bring forward a small charge, will it really hurt UPI and significantly dent UPI volumes? Your thoughts?
Oh, yes, it will dent UPI volumes, obviously. India is a price-sensitive country in that sense. But think about it, if you have such a large cost that you incur, and I know it's compared to currency cost, etc., it is much less. But the fact that you incur such a large cost would not make any long-term sustainability possible. So ideally, what needs to happen at some stage is that for above a particular threshold, maybe you can say 500 rupees or something like that, there needs to be some charge that could come in. So today, for example, people who pay hotel bills, or people, restaurant bills rather, or people who pay for certain utilities above a particular amount, or people who go to, supermarkets and purchase stuff off UPI, those are the people who should be incurring some kind of cost. And I think I'm in favor of having some reimbursement or some MDR charge on it. What I'm not in favor of is, say, small street vendor type payments, people whom you've got into the banking system or into the formal system. Those kind of payments, I think, will become more sensitive to any non-payments. So, take a threshold, I take 500, you could take 300. But whatever threshold one takes, I think there has to be some charge at some stage. Otherwise, sustainability is always a question.
Because the government provides whatever it provides through the budgetary support, right? I mean, obviously, it's not enough. It could provide more, perhaps, in that sense.
No, that's what, you can provide something through budgetary support, but budgetary support is not sustainable models. See, what you really want also is that while there is UPI and there is government-based UPI, there are other service provider models that are emerging. There are the likes of Paytm, as we have somebody on there. Or there are similar other models. And I think sustainability, investment in technology, avoiding of risks, investment in cybersecurity, etc., will require some level of business model to be in place. And we are a Robin Hood country. So you have large transactions trying to subsidize smaller ones. That would make business models more sustainable.
Robin Hood country. Point taken. Pranav, just reflect on some of what Bazaar said. From a regulatory, long-term sustainability point of view, what's your sense?
Yeah, I think there are two parts to this. One is the regulation part, and second is the competitive intensity part. So even if, let's say, RBI and NPC and government agree and bring in an MDR, our view is it will go down the route of the IMPS transactions or the NEFT transactions, where in theory, there's a charge which could be applied for transactions, but for all practical purposes, most banks have waived it off. Because today, let's say MDR is allowed. There is a long list of banks who really want to get back into the payment space, which they realize they have ceded to the fintech platforms and would be happy to subsidize zero-cost payments. So one is the regulation part itself. Second is the competitive intensity, where we've seen that these are completely replaceable products. I mean, if we saw that when regulatory actions hit Paytm, customers moved almost instantly to other platforms. So there's no switching cost involved. And therefore, the ability to charge would be quite minimal. The way it is visible is if you look at some of the other internet platforms, take your food delivery or e-commerce, they've already started flexing their pricing power by introduction of platform fees, search fees, and whatnot. We don't see that really playing out in the payment space, which tells you of the pricing power that these platforms have, which is pretty much non-existent. So online transactions, maybe yes, because you don't have the cheap option of cash or zero-cost option of cash. Maybe there's some pricing power there. But for offline transactions, we expect it to remain near zero. And this is the same we have seen in other markets. Like if you take China, for example, where it was a duopoly, there was no restriction on charging MDR, but still the offline transaction costs or MDRs were nearly zero. So the chances of any big revenue upside, while on paper it looks massive, right? I mean, if you charge a few 2-3 basis points on the volume of transactions, it'll have significant impact on EBITDA for Paytm or PhonePe, any of these businesses. But the probability of that playing out seems to be extremely low at this point.
No, absolutely, got that. Pranav, when you began by saying the cost, the benefits outweigh cost. Have you done any analysis? And you said there'll be if some cost is put on, banks will waive it off. There's enough banks wanting to gain back a market share, which is ceded. Have you done any work in terms of what this some of the biggest players are able to do by offering this free of cost and make up in terms of revenue otherwise in other segments, lending, etc.?
Yes. So we have done the analysis. So for example, let's take banks, the different stakeholders. The cost savings for banks in terms of reduced ATM transactions, the ATM transactions have come off by 30-40% from the peak, pre-COVID peak. And the cost saved there would almost be equivalent of earning about 10 to 12 basis points on the UPI transactions. So that's the amount of cost savings that they would have enjoyed. So they wouldn't want to risk it. Similarly, for the government, simply the reduced printing cost would be equivalent of 2 to 3 basis points of UPI transactions, merchant transactions, and that's close to what they are actually paying out as a subsidy. The other revenue addition that banks have got is simply the ability to lend. So if you look at the business banking growth that many of the banks are seeing, some of that or a large part of that is being enabled by the transaction history that is now being generated, which allows them to underwrite those customers. Lastly, the payment platforms itself. Now, while yes, there is a cost involved in providing the payment infrastructure, the fact that a Paytm is able to break even today tells you that there are other ways of monetizing, be it in terms of providing loans to merchants, the sound boxes where they earn a revenue. So people have figured out other monetization avenues, and that seems to be enough to break even. Now, you need to therefore look at it as a whole and not as a single service that's being provided. It's the same as ATM transactions. ATM transactions are free in the country, at least for 5-6 transactions. There is definitely a cost involved, significant cost involved, but nobody gets charged because the bank earns money in a different place. They get cheap savings accounts, which is the revenue source. So we need to look at it at a holistic level and not just based on the payment transactions. And if there is one particular entity that's incurring more cost, then I think it boils down to their negotiating power in the ecosystem and therefore the ability to charge and earn a revenue.
Well put. Abhisar, while you are advocating for perhaps some sort of a tiered structure, high value transactions are charged, there is a commission on that, but there is a competitive angle that Pranav was talking about. And also UPI has been such a phenomenal success story. Like, I mean, it's something that the government is also very proud about. So will there not be that populist pushback that if they go ahead and introduce this, regulatory charge?
Certainly there will be a pushback. There's no doubt about it. But what part of the segment are you charging? If you charge a fruit vendor, of course there'll be a pushback. And I'm not asking that there should be a charge on a fruit vendor. What I'm saying is that UPI today is benchmarked with a free service. And that is why that service is not valued in the ecosystem. So for example, take a Swiggy. A Swiggy knows that if I am ordering some food worth 5,000 rupees on Swiggy, the UPI transaction is free any which way. But if there was a charge mechanism that UPI did, there would be competitive forces coming in who may provide better payment services. And even if UPI charges some charge to it, that is a benchmark cost allocation that Swiggy will have to do to that payment provider. So I think that ultimately a service, if it is classified as free, will never get valued. But if a service is put some value to, then for larger transactions, it will do. What UPI has achieved and phenomenally achieved, 16 billion transactions last month, February 2025 actually. But if you look at it, it is a phenomenal way of shifting people to the formal system. I think the government has done their job. What had to be done is done now. We are so used to Swiggy. It's like Reliance Jio trying to offer you initially internet free. I know in my area, internet was free for the first few months, and now I can't live without it, and I pay whatever they charge me for it. So as a premium user, I think this country, as I said, is about inequality. It's a Robin Hood country. So at the end of the day, the people who are privileged enough should be paying for this service. The service will only mature. The government subsidy can then be diverted to slightly better people, and alternatives to UPI will come in, which will get UPI to upgrade its own technology. So there is nothing wrong in having a revenue model which enables people to provide better service levels through investments in technology, investments in risk. Think about the issues that may happen if these payments are incorrectly done and the technology is ignored. So I just think that while there are other ways of making money and people will figure out ways of making money, and banks may say, I will absorb the cost, but let there be a cost.
Let there be a cost. Got that. Thank you, gentlemen, for that. So two sides of the story, but there is that convenience, efficiency, speed angle, and perhaps there should be a charge for that. Thank you very much for joining in. Here's what we will do. We will slip into a very short break. We'll come back and talk commodities on the other side. Don't go anywhere. Well, it's all happening in the commodity markets. Manisha is now joining in to put the spotlight on the crude market.
Thank you for that. Well, yes, you woke up with a very strong gain coming in for the crude oil prices. Until last evening, we were down by 2%, by the way, in the New York session. It all started happening in early Asia markets that you saw the crude oil prices open up at 5% to 6%, went all the way up to 12% as well, and it's trading 10% on the higher side right now. If you look at the prices, then we are up by 17% in this week, and this is the best weekly gain that the crude oil prices have seen since the year of 2022 there. And if you look at the last 1 month, we've turned positive here as well, up 20% now. And in this year as well, we've turned in the positive. Until last week, we were down by nearly 7% for the crude oil prices. But as you can see on your screens, with the kind of gains that we have seen coming on today, we are up by nearly 6% for the year right now. And when you look at the previous last 2 years, well, of course, the crude oil prices are still trading into the negative there. But this year has seen positive. The cues clearly coming in early morning after Israel conducted a preemptive strike on Iran. And the various statements that have been coming in from Israel as well are keeping the crude oil prices up at 10% in the Asian markets right now. The attack does set off a new conflict in West Asia, and there are now fears of regional war as well coming in, supporting the prices. Well, Israel has declared a state of emergency as it braces for retaliation from Iran. Iran, remember, has been issuing statements saying that it can retaliate not just on Israel and other countries, but especially on US bases as well. Iran has threatened to target US bases if nuclear talks fail. We also have seen reports that Iran could soon retaliate against Israeli targets, including civilian areas as well. So this whole Middle East tensions is what has led to the crude oil prices boiling, as it were. The prospects of broader conflict in West Asia and the fact that it could lead to supply disruptions going forward as well is what is leading the prices where they are. Strait of Hormuz is an important vital route, remember, and nearly 20% of global oil flows through here. Red Sea concerns are still ongoing. We've seen those container freight issues continue into the market, and this could be an added one. The U.S. personnel, in the meanwhile, have continued to move out of the region with ongoing threats. This has been happening for the last 2 or 3 days now, ahead of these attacks and the kind of statements that we saw from Iran coming in as well. Interestingly, importantly, Trump also yesterday said that he expressed actually frustration that oil prices had risen amid supply concerns within the Middle East, and that he doesn't see oil prices moving beyond 70 or 75, but we are trading at around $76 a barrel at this point in time. It's not just about crude. When you look at the crude derivatives like natural gas, heating oil, gasoline, those prices are trading above nearly 4% right now. We're trading at multi-week and multi-month highs for many of these commodities at this point in time. So when you look at the prices itself, well, last month was a good one. We saw 11% of gains coming in for the month of April, and May was up 11%, and June is up 18% at this point in time. And if you look at the crude oil prices on an year-on-year basis, the last couple of years were in the negative. We saw 10% of decline in 23, down 3% for 24, but we are up by 5% in this year now. Last week, it was down by 6%. We're trading 5% on the higher side right now. So that 11% of a move clearly comes in the overnight markets.
Thank you very much for that. Get into a break. On the other side is our special segment. It's the Economy. Lata speaks to Hitendra Dave, head of HSBC South Asia, on tariffs, geopoliticals, and the India growth story.